Hello students. This video will discuss Chapter 5, Learning Objective 1. For Chapter 5, we'll discuss gross income and exclusions. And here are the learning objectives. We will focus on Learning Objective 1 in this video. The objectives of this chapter, again, pose 3 questions. Number 1, what are realization and recognition, and when do they happen? Number 2, what are the distinctions between various income sources from service and property? Number 3, how to apply basic income exclusion provisions to compute gross income. Gross income. Gross income is income that taxpayers realize, recognize, and report on their tax return. What is included in the gross income? Let's look at the regulation. Reg section 1.61-A, gross income means all income from whatever source derived, unless excluded by law. Gross income includes income realized in any form, whether in money, property, or service. Based on Internal Revenue Code section 61A and Revenue Regulation section 1.61A and various judicial rulings, taxpayers recognizes income when 1. They receive an economic benefit. Number 2. They realize the income. And 3. No tax provision allows them to exclude or defer the income from gross income. So that's defined economic benefit. Economic benefit. Taxpayers must receive an item of value of economic increase from certain event to have economic benefit. For example, cash, property, or services in exchange for work or services rendered. Number 2, properties, sale proceeds. Number 3, investment or business income. What will be the realization principle? The tax definition of income per Revenue Reg section 1.61A adopts the realization principle. Income is realized when 1. A taxpayer engages in a transaction with another party, and 2. The transaction results in a measurable change in property rights. That is, assets or services are exchanged for cash, claims to cash or other assets with determinable value. This one, please see example 5-1 on page 5-3. What about recognition? Taxpayers who realize an economic benefit must include the benefit in gross income unless a specific provision of the tax code says otherwise. Some of the realized amount may be excluded, for example, tax-exempt interest income or deferred. What about other income concept? Form of receipt. Taxpayers do not have to receive cash to realize and recognize gross income. Based on Revenue Reg section 1.61A, indicate that taxpayers realize income whether they receive money, property, or services in a transaction. Thus, even two parties engage in bartering activities. This one you can see example 5-2 on page 5-4, the realization still occurred. What about return of capital principle? A portion of the proceeds from a sale represented return of the cost or capital investment, or what we call the tax basis, in the sale of a capital asset. Thus, when receiving a payment for property, taxpayers are allowed to recover the cost of the property tax-free. For example, taxpayer A paid $5,000 for a piece of land and later sold it for $6,000. The $5,000 A paid for the land is a tax-free basis. A has realized a gain of $1,000. Sales price for $6,000 minus the basis of $5,000, and must recognize this income of $1,000 in A's tax return. What about recovery of amounts previously deducted? A refund is not typically included in gross income because it usually represents a return of capital. However, if the refund is made for an expenditure deducted in a previous year, then under the tax benefit rule, the refund is included in gross income to the extent that the prior deduction produced a tax benefit. For example, a taxpayer paid $1,000 business expense claim as a 4 AGI deduction in 2013, but 250 of the expense was subsequently reimbursed in 2014. Because the $250 business deduction produced a tax benefit in 2013, reduced the taxpayer's taxable income. The $250 refund in 2014 will be included in income. Therefore, if you deducted the expense in prior year tax return and part of the expense has been reimbursed to you, then you must include the amount of reimbursement in your income. And let's look at this example. This one is very similar to example 5-3 on pages 5-5 and 6. And then also, actually, the 5-3 is a better example, but for the time constraint, that we're going to look at this example. Example 5-3 actually it has different scenarios in applying the tax benefit rule. So let's look at this one. Last year, Courtney reported $8,900 in itemized deduction, including $3,500 state income taxes paid last year. The standard deduction last year was $8,700. In March this year, Courtney received a $420 refund of the $3,500 in state income taxes paid last year. Under the tax benefit rule, how much of the $220 refund should Courtney include in her gross income this year? Well, based on the rule, if you already deducted from the prior year, then anything that refunded, then it must be included. But let's look at whether the itemized deduction and the standard deduction has some impact on it. And so it will be $200. The deduction of $400 only reduced Courtney's taxable income by $200 because of the total itemized deductions cannot drop below the standard deduction. So here, because of the difference between $8,900 and $8,700, the benefits that Courtney received is only the $200, not the entire $400 state income tax refund. So when do taxpayers recognize income then? So we talk about realize and recognize, right? Yeah, taxpayers' method of accounting generally determines the year in which the realized income is recognized and included in gross income. So accounting method will determine when the income is recognized. Accounting methods. Number one, we can use accrual method. Income is generally recognized when earned and expenses are generally deducted in the period when liabilities are incurred. Number two, we can use cash method. Income is generally recognized when cash is received and expenses are generally deducted when liabilities are paid with cash. So one is whenever it happened, and then the cash method is only when cash has been exchanged. And what about constructive receipt? This one you can see example 5-4 on page 5-7. The constructive receipt doctrine states that a taxpayer realizes and recognizes income when it is actually or constructively received. Constructive receipt is deemed to occur when under one of the four possible scenarios. Number one, the income has been credited to the taxpayer's account. Number two, the income is unconditionally available to the taxpayer. Number three, the taxpayer is aware of the income's availability. And finally, number four, there are no restrictions on the taxpayer's control over the income. In other words, if you have sort of access or control over it, even though you have not received the cash, then they still consider that you have constructively received the payment or cash. Claim a right. The claim a right doctrine states that income has been realized if a taxpayer receives income and there are no restrictions on the taxpayer's use of the income. For example, the taxpayer does not have an obligation to repay the amount. For example, a taxpayer received a bonus based on sales volume with a clause to return part of the bonus when a material volume of the sale has been returned after the receipt of the bonus. Regardless of what may happen in the future, the taxpayer must include the entire bonus amount in gross income since there is no restriction to the use of bonus. So who will recognize the income? So is that the person earn it, or you can just assign your pay to somebody else? According to the assignment of income doctrine, taxpayer cannot arbitrarily transfer the taxation on their income to others. In other words, the taxpayer who earns income recognizes such income and may pay income taxes on the income. This one, please see example 5-5 on page 5-8. Community property system. 9 states of the Union implement community property systems, where the income earned by one spouse is treated as though it was earned equally by both spouses. Property acquired by either spouse during the marriage is usually community property and is treated as if owned equally by each spouse. This one you can see example 5-6 on page 5-9. So here we can look at some of these items. Impact on federal income tax consideration under different law systems. On one column, we can look at the community property system. Number one, half of the income earned from services of one spouse is included in the income of the other spouse. Number two, half of the income from property held as a community property by married couple is included in the gross income of each spouse. Number three, in 5 community property states, all of the income from property owned separately by one spouse is included in that spouse's gross income. Number 4, in Texas, Louisiana, Wisconsin, and Idaho, half of the income from property owned separately by one spouse is included in the gross income of each spouse. What if the tax consequences under the common law system? Number 1, all of the income earned from the services of one spouse is included in the income of the spouse who earned it. Number 2, for property owned separately, all of the income from the separately owned property is included in that spouse's gross income. Number 3, for property owned jointly, each co-owner is taxed on the income attributed to his or her share of the property. So there are some differences. For these learning objectives, we pretty much discuss what's income, how to recognize it, who should recognize it, and who should report, and also who has the liability to pay the income taxes. For those of you who have additional questions regarding this learning objective, please post your question on either the discussion or the virtual office. Thank you.